You're watching Trading Day on BNN Bloomberg. We're tracking bank stocks that are two of them that are going in different directions. Scotia is bouncing after its earnings beat expectations. BMO, on the other hand, another ugly surprise when it comes to credit quality. For a look at this, let's bring in Paul Bagnall, who's been on the file. And for what to do with the stocks, we've got Dan Rohinton, portfolio manager at IA Global Asset Management. Paul, why don't we start with you? Kick it off. Let's go through the nuts and bolts of the quarter.
Sure. We'll start with the good news story of the day, Amber. That's Bank of Nova Scotia. We've seen Scotia stock up about 2% as investors applaud these results. Scotia narrowly topped earnings expectations, very narrowly by a single penny, as we'll see in a moment. There's the stock up close to 2%. $1.63 was the adjusted earnings per share from Scotia. That reflected $2.2 billion in adjusted profit. And significantly, the company saw growth, a strong single-digit profit growth in both Canada and in its big international banking segment. Canadian banking profit rises by 6% to $1.1 billion in the important international banking segment, largely active in Latin America. Profit rose by 7% to $674 million. PCLs did rise a reasonable or a modest 4.5% from the prior quarter. And this is a real theme in these bank results, rising provisions for credit losses as economies in North America and quite likely in Latin America slow down. But as you noted earlier, the provisions for credit losses number was less than the market had expected. Here's the negative story of the day, the bad news story. Bank of Montreal missing earnings expectations by a wide margin. That $2.64 in adjusted earnings per share was 11 cents short of what the street was expecting. And perhaps as expected, it was loan losses that were the story at Bank of Montreal, provisions for credit losses. I say perhaps as expected because the numbers came in worse than even some fairly pessimistic expectations. Here's how the numbers stacked up at BMO. Canadian personal and commercial banking profit up 3%. U.S. personal and commercial banking profit down significantly by 7% to $539 million. That provisions for credit losses number, remember Scotia's rose by 4.5% from the prior quarter. BMO's were up 28% from the prior quarter to just under $1 billion or $906 million. And the bank did say early on in its statement that the provisions for credit losses experience was, quote, above our historical average.
You know, sometimes these conference calls can be quite placid, but I noted for the BMO one, there were a lot of hard-hitting questions and use of the word like, what went wrong?
Right.
Where are your errors on diligence? Can you identify the failures? And analysts consistently went back. They were not really satisfied with the answers that they were getting.
Some of the reaction we've seen on BMO is all about the credit loss numbers. One analyst, Gabriel Deschênes at National Bank, says he believes the bank is in cleanup mode now and believes the bank, and I believe there was some forward-looking guidance from the bank on this, will have elevated provisions numbers for the next 1 to 3 quarters. That's what Deschênes headlined his report early this morning, his initial report on the numbers. If not for higher credit costs, it would have been a good quarter. Meanwhile, Matthew Lee at Canaccord Genuity Capital Markets headlined his report early this morning. Credit challenges continue to stymie earnings growth. That is very much the story at Bank of Montreal. And the bank provided a fair bit of detail on where the heavy losses are coming. In terms of impaired loans, these are loans that are already behind in their repayment. In the U.S., it's commercial real estate and manufacturing where the biggest numbers appear, about $1.2 billion in the aggregate between those two sectors.
All right. Thanks so much to Paul Bagnall. Let's bring in Dan Rohinton, portfolio manager at IA Global Asset Management. And Dan, you don't own BMO, and I guess maybe you're breathing a little bit of a sigh of relief. But when you look at the sell-off, I mean, it's not every day that we see bank stocks, the big five selling off 7% in a single day. What's your assessment of what's happening at BMO?
So it's actually pretty much par for the course for BMO. You just need to zoom out in terms of the time horizon, Amber. So we sold our position in BMO, but realistically, that's more of a function of commercial credit gets weaker first, and that's what we're seeing at BMO. BMO is a more commercial lender than some of the other Canadian banks. So it feels like BMO has an idiosyncratic credit issue I don't necessarily believe that's the case. I think it's just more common that commercial credit goes first, then unsecured credit on the consumer side, and then finally it's the resi secured stuff. So BMO's balance sheet is just more predispositioned for this type of come out of nowhere credit loss. And that's just how commercial works. It's lumpier, it's chunkier, and when the workouts happen, the loss given default gets basically thrown up in the air, which is why coming out of the cycle in the other direction, the recoveries on commercial are even greater too. So it's just a little bit different than what we're used to as Canadian investors, but this is following a playbook that we have seen, especially in the US franchises. So I'm actually reasonably constructive on BMO from here, but I would acknowledge that it's a little bit too soon. And also the other Canadian banks, I wouldn't necessarily wave the victory flag on credit just yet. I think their time is more likely to come in the coming quarters, as opposed to BMO getting the headlines today.
Okay, I want to unpack two parts of that. The first is that this is maybe a harbinger of things to come, that it's not a ring-fenced issue for BMO, that commercial credit is the first domino to fall. Can you elaborate on your thinking on that?
Yeah, absolutely. What tends to happen is that the commercial, take for example, one of the suspected issues that they saw, the Yellow bankruptcy. That was a trucking company that basically had an asset sale and a parse out of its different pieces. First, you have to go bankrupt as a company or have to do workouts before you stop paying your employees and downsize and restructure for the next iteration that you're going to look like. So commercial losses for the banks get seen first, and commercial migration gets seen first because you're unlikely to have bigger employee changes, compensation changes that someone who's paying a credit card off and paying their monthly balances or their residential mortgage payments, you don't get the income shock until the commercial shock comes first. So that's what I mean. It comes first, but with the lag, the other pieces come. I would also just say, and really drive the point home, Amber, is right now we're still talking onesies and twosies. So BMO's absolute provision has stepped up quite a bit, but we're not in some crisis environment. We're actually just back to its longer term averages and maybe a little bit above then, depending on the quarter. So it's really a longer term statement that commercial credit is weaker, then consumer credit gets weaker over time. With the unsecured consumer credit, think of your credit cards, your unsecured line of credits, that's where the losses really manifest itself when we do go through a credit cycle. That's the historical experience.
So I'm glad that you brought that up. This was actually raised on the Scotia call, an analyst asking about people have been waiting now for a couple of years for those unsecured losses to show up, and they're not. And so the question, in a meaningful way, and the question was basically like, so does that mean maybe that is a no landing scenario as well? Like we've talked about the US and a no landing scenario. It sounds like you wouldn't get too confident in the idea that unsecured credit doesn't land.
I think it's too early to really draw a decisive conclusion. And part of what we're seeing is we're seeing still relatively robust growth, relatively full employment across the US and Canada. So the fraying and the slowdown is really more at the edges than in the core of the economy. So I think it's too early in terms of where the soft landing versus harder landing conversation is going. But the most important driving force behind credit losses is you have to lose your job first before you stop basically doing an abrupt bankruptcy or anything like that. So unemployment is the leading indicator for credit losses and actual charge-offs. So we haven't seen mass unemployment. We haven't seen any of those issues manifest itself, but you need to see that first before you really start seeing the pain in unsecured credit. So we haven't seen the first derivative, so we can't expect for the actual banks to see the headwinds associated with that.
Okay, and I want to go back to your original. No, it's good. We need these explanations, and it's complex. Your original point where you said maybe now BMO is getting a little bit more interesting, and I get that you're not ready to pull the trigger. But I just want to ask the question in the context of all the analysts, seemed concerned that there are underwriting failures or mistakes that were being made. Questions about how are one or two loans moving credit so meaningfully from quarter to quarter? Are these flags that are going up for you in your consideration that BMO is getting a little bit more interesting as a buy?
So I'll start by saying I've covered financials for a long time globally, so none of this surprises me. It's actually very much par for the course. So it's unique in Canada because we really aren't used to credit losses in a real way. But in a global context, in terms of the limits BMO has, in terms of the commercial credit book, BMO Harris, and Bank of the West, which isn't really part of this conversation right now, is a pretty normal U.S. regional bank. So in terms of the lumpiness of the credit losses, that's just the way mid to large ticket commercial happens. That the check sizes are just bigger. So if something goes wrong, it just naturally sticks out versus hundreds of credit card borrowers or thousands of credit card borrowers going bankrupt based on unemployment trends and broader macro drivers. So the lumpiness is part and parcel with commercial. And as a whole, I think just taking a step back, I think we're in a unique place with the Canadian banks because you can really choose your own adventure. Most of these companies, except for, frankly, Royal Bank, trades at around 10 times forward earnings. So if you want a LATAM footprint at 10 times earnings, or a US regional bank footprint in the case of BMO at 10 times earnings, or CIBC, which is a little bit more Canadian oriented and more in the Northeast, or National Bank, which is more Canada focused, or TD, which is generally the big catch-all of it all, they all trade around the same valuation. So the question from here is, what economic environment and what mix are you predisposed towards over time? And I would say BMO, as we work our way through, I'm more interested in, but right now I'm sticking with Royal. But I can see a future where we're trimming our Royal Bank position and adding more to BMO. We're just not at that place yet.
Dan